The early-stage startup ecosystem operates in a state of high entropy. Founders build products for markets that may not yet exist, navigating unpredictable competitive landscapes. To navigate this uncertainty, venture capital has traditionally leaned heavily on human intuition. Investors evaluate opportunities based on charisma, a compelling narrative, or fragmented performance metrics. This reliance on subjective impressions creates a persistent structural flaw. It leads to environments where operationally strong businesses are starved of capital, while fragile businesses secure vast sums of money. The root cause of this misallocation is the conflation of two entirely distinct variables. Executing an effective investment pitch requires a specific skill set that differs from the requirements of building a viable, enduring company. To separate the narrative from the underlying mechanics, Dr. Bitan Ghosh developed the 11th Index. It introduces a comprehensive, structured methodology designed to measure these variables independently. By replacing subjective guesswork with structured analysis, we can evaluate startups based on measurable preparedness rather than presentation polish. The first objective is to quantify a startup's intrinsic operational strength. The framework defines this metric as investment quality. This radial diagram maps out 11 dimensions to evaluate that quality. Rather than relying on single data points like market size, the index examines everything from business model viability to operational readiness. Zooming into the first dimension, founder and leadership strength, reveals the evaluation's granularity. The framework avoids assessing leadership as an abstract feeling. It breaks the dimension down into 10 specific parameters, requiring rigorous assessment of traits like domain expertise, crisis management capability, and a founder's agility in adapting to new information. Each of these 10 parameters is assigned a rigid grade on a scale of 1 to 10, requiring evaluators to justify conclusions with observable evidence. This equation calculates the average of those 10 parameter scores to generate a single, definitive dimension score. That exact scoring process is then repeated systematically across all 11 dimensions of the startup's profile. Measuring multiple variables simultaneously prevents impressive vanity metrics, like a sudden spike in user acquisition, from masking critical deficiencies in long-term governance or cash flow discipline. However, expectations appropriate for a pre-revenue startup are entirely different from those applied to a company preparing for an IPO. Evaluating both with identical criteria produces a mathematical error in the risk profile. This timeline tracks the standard startup lifecycle, progressing from idea to pre-IPO stages. To account for this maturation, the framework introduces stage-dependent assessment rigor. The importance of specific dimensions actively adjusts based on this timeline. During the pre-seed stage, founder strength carries the maximum mathematical weight. Financial performance data is usually non-existent here, so the evaluation must focus on the potential of the leadership team. As the company matures, mathematical weight dynamically reallocates toward financial discipline and governance standards. Finally, we multiply each dimension score by its stage-specific weight and sum them into a standardized figure out of 10. This final output is the investment quality score. By scaling the math to the lifecycle stage, investors avoid penalizing an early startup for lacking a corporate governance board and avoid excusing a late-stage company for burning cash without a clear path to profitability. Yet an anomaly remains. Startups frequently achieve high investment quality scores but still find themselves completely unable to secure venture capital. This happens because being an investable business is not synonymous with being prepared to successfully raise institutional funds. Here on the right, we introduce a second framework, funding readiness. This measures a startup's organizational maturity and ability to withstand investor scrutiny. It is broken down into 5 distinct dimensions, evaluating the clarity of financial reporting, preparedness for exhaustive due diligence, governance structures, and transaction strategy. This new formula applies the exact same 1 to 10 scoring system and stage weighting logic to these 5 dimensions. The result is a secondary output, the funding readiness score. Formally separating a company's ability to raise capital from the actual quality of its product ensures that investors are evaluating evidence of maturity, rather than being charmed by a highly rehearsed pitch deck. With these 2 metrics established, we arrive at the ultimate question: how do we definitively measure a startup's overall viability for investment? We must synthesize the investment quality score and the funding readiness score into a single calculation. The philosophy driving this calculation dictates that intrinsic business health must always take precedence. A brilliant fundraising strategy cannot compensate for weak unit economics. Therefore, this final equation merges the two scores at a strict 70-30 ratio, heavily favoring the intrinsic strength of the business. The output on this meter is the Capital Readiness score. A high mark on this scale validates both the core value of the business and the maturity needed to deploy new capital responsibly. If we plot investment quality on the y-axis and funding readiness on the x-axis, we generate a 4-quadrant matrix. This translates the mathematics into a practical diagnostic tool. Startups scoring low on both axes fall into the bottom left. These are emerging opportunities. They require structural business development before seeking outside capital. The document describes the top left as hidden gems, companies with strong mechanics that struggle to communicate their value. Further down are presentation-driven ventures in the bottom right. These startups demonstrate strong fundraising preparation but weak underlying mechanics, representing the highest risk of capital misallocation. Returning to our grid, the top right quadrant highlights capital-ready leaders. This is the target profile, the ideal convergence of business quality and institutional preparedness. As an objective decision support tool, the index identifies patterns of preparedness without claiming to forecast market shifts with absolute certainty. By structuring our evaluation, the 11th Index provides clarity. It helps founders build better, more resilient startups. It allows investors to make disciplined decisions, and it ensures that capital flows thoughtfully toward the businesses that actually deserve it.